The top 6 best investments in 2022. For the majority of people, investment is a necessity if they want to enjoy a secure financial future. A seemingly steady economy can be abruptly flipped upside down, as the coronavirus pandemic showed, leaving individuals who weren't prepared for hard times scrambling for money. What are the greatest investments for investors to make this year, though, given that the economy is reeling under a wave of rising inflation? Combining safer assets with riskier, higher return ones is one strategy. Why invest? While investing can help you accumulate wealth, it's important to weigh the risks and potential rewards. You can use investing to supplement your income, finance your retirement, or even get yourself out of a tight spot financially. 1. High Yield Savings Account. You get interest on your available funds when you have a high-yield online savings account. For risk-averse investors, particularly those who require money immediately and want to minimize the possibility that they won't get it back, a high-yield savings account is a good option. The risk. Although high-yield savings accounts are regarded as safe investments, similar to CDs, if rates are too low, you run the risk of losing purchasing power over time due to inflation. 2. Short-term government bonds. Mutual funds or exchange-traded funds, ETFs, called government bond funds, invest in debt securities issued by the U.S. government and its agencies. When interest rates climb, as they have since the beginning of 2022, short-term government bond funds don't expose you to a lot of danger. The low-risk investor might do well with these government bond funds. They may also make a fantastic option for novices. Investors that are risk-averse may benefit from government bond funds, albeit some categories of funds, such as long-term bond funds, may fluctuate significantly more than short-term funds due to changes in the interest rate. The risk. The price of current bonds decreases when interest rates rise, and increases when interest rates fall. Long-term bonds are more susceptible to interest rate risk than are short-term bonds, although short-term bond funds will be less affected by rising rates and will gradually raise their interest rate as market rates rise. Rising rates will have little effect on short-term bond funds, and the funds will gradually raise their interest rate as market rates climb. 3. Series 1 bonds. Individual investors can purchase savings bonds from the U.S. Treasury, and the Series I bond will become more and more popular in 2022. This bond contributes to the construction of inflation protection. In addition to paying a base interest rate, it also includes an inflation-based component. The result, if inflation rises, so does the payout. The risk. The primary disadvantage of investing in most bonds is the risk of inflation. The Series I bond eliminates this risk, and like other government-issued debt, these bonds are among the safest in the world in terms of default risk. 4. S&P 500 Index Funds. An S&P 500 Index Fund is a fantastic solution if you wish to attain larger returns than more conventional banking products or bonds, albeit it does have more volatility. Approximately 500 of the largest American corporations make up the fund, which includes many of the most prosperous global businesses. An S&P 500 Index Fund, like almost any fund, provides immediate diversification by letting you own a portion of each of those businesses. The index has historically returned roughly 10% yearly. For novice investors, an S&P 500 Index Fund is a great option since it offers extensive, diversified exposure to the stock market. The risk. Due to its composition of the best companies on the market and extensive diversification, an S&P 500 fund is one of the less dangerous ways to invest in equities. It still contains equities, thus it will inevitably be more erratic than bonds or any other bank products. Additionally, since the government does not cover it, value changes may cause you to lose money. 5. Value stocks funds instead of growth stocks. Value stock mutual funds might be a wise choice. Value stocks, which are more affordably priced than other market securities, are the focus of these funds' investments. Value equities also frequently perform better as interest rates rise. For many investors, another draw is the fact that many value stock funds also pay dividends. The risk: due to their low cost, value stock funds will typically be safer than other stock fund types. However, because they are still made up of stocks, they will vary far more than safer assets like short-term bonds. Additionally, they do not have government insurance. 6. Rental housing. If you're ready to handle your own property management, investing in rental housing can be a wonderful decision. And even though mortgage rates are rising, it might still be a good moment to finance the purchase of a new home, even though the shaky economy might make maintaining it more challenging. You'll need to choose the appropriate property, finance it or buy it outright, maintain it, and deal with renters if you choose to go down this path. You won't, however, be able to use your internet-enabled smartphone to purchase and sell your assets in the stock market with a simple click or a tap. However, if you keep on to your assets over time, slowly reduce your debt, and increase your rental income, you'll probably have a strong cash flow when it's time to retire. The risk: you can overspend for housing, just like you do with any asset, as investors did in the mid-2000s. Despite the economy's difficulties, property prices rose in 2020 and 2021 due to low mortgage rates and a shortage of available homes. If you need to replace anything like your roof or air conditioner, you may need to come up with a significant amount of money, and inflation may have a significant impact on the price of doing so. Additionally, you incur the danger of having an empty property while making mortgage payments. What to think about? You should think about your risk tolerance, time horizon, investing knowledge, financial condition, and the amount of money you have available to invest as you choose what to invest in. If you want to increase your wealth, you can choose assets with lower risk but lower returns, or you can choose investments with higher risk but higher returns. Investing often involves a trade-off between risk and return. Alternately, you can adopt a balanced strategy, making 100% safe financial investments while yet allowing yourself the chance for long-term success. If you have enjoyed this video, please give it a like and subscribe, and don't forget to turn the bell notification on so you don't miss a video. Thanks for watching, and I will see you all next time.